Dividend investors, bonjour, Mike Héroux here, founder of Dividend Stocks Rocks and passionate investor. This week is one of my favorite weeks because it is bank earnings week. Today we are going to review ScotiaBank and BMO that started this Tuesday with their earnings. It's going to tell us a lot about the Canadian economy and where we could expect other banks, but also the other companies where they should go in the upcoming quarter. So it's always one of the most important results that we're going to see today. I'm telling you right up there, BMO just killed it, but we're gonna start with ScotiaBank. ScotiaBank, most international bank, you know the narrative by now. If you look at the dividend triangle, we can see that the bank is going sideways in terms of price. It is still trading around the 2017 price. Revenue has been doing good, not incredible, but you'd see it's always on an uptrend, so that's great. But obviously, provision for credit losses took a huge dent in their earnings projection in 2020. You can see that since 2018, though, between 2018 and 2020, not much happened over there. So it's kind of a bit of a situation here. I know that Scotiabank did a lot of transactions during that time. They wanted to have more exposure to Chile. They made acquisition over there. So maybe this is why it is going sideways for a few years. Obviously, don't expect too much out of 2021, but so far it looks like a good year. You can see dividend has been, the dividend growth has been paused in 2020. It's the case for all banks. Actually, they are not allowed to increase their dividend right now. I don't think they would do it anyway. I think that they would go with a more cautious approach. But in the meantime, no dividend increase this quarter for all 6 banks. I'm pretty sure that's what's going to happen. So nothing there. So we're not going to discuss dividend too much today. We're going to focus on each business segments and then look at their provision for credit losses and their total loan portfolio. This is the nerve of this year to see how the economy has gone in Canada, in the US, and outside. So we'll have a very good portrait of what's happening with Canadian banks. So, overview for Q1 for ScotiaBank. Overall, earnings per share went up by 3% versus last year, so nothing to write home about. Obviously, management will focus on the sequential difference between Q4 and Q1, which is up 30%. So, it makes you feel a little bit better as an investor, obviously. What I have circled right there, squared actually, in red is their international banking. They didn't do too well here, minus 32% for earnings. So this is not where they got their growth. Canadian banking was pretty much flat. And then the growth came from global wealth management and global banking and capital markets. So let's see a little bit wow each segment have done to know where it's coming from. So Canadian banks, what we see here is surprisingly a growth for loans, 4% up, residential mortgage 7% up. So the pandemic has kind of like had the opposite impact that a lot of people expected. I thought that people would borrow less and maybe try to focus on pay down their debts, but it's quite the opposite. They kind of felt that they needed change. We see that the housing market in Canada is pretty strong, and this is being reflected in Scotiabank's results. Unfortunately, this growth has been hurt by the lower interest rate, so they kind of suffer from interest margin squeeze. So one good news is being offset by the others, and this is why earnings are up only by 1%. I'm not going to discuss provision for credit losses, PCL, at the moment. I'll get there in a few slides instead because we have like a complete portrait later on in the presentation. And for international banks, as I mentioned earlier, this hasn't been the best quarter for them. The PCLs is a little bit better than last year. So it's down 5%, which is good news. But when you dig deeper, you realize on the right side of this graph, explaining a little bit more what's happening, is loan has increased, but unfortunately, provision for credit loss after the adjustment has also increased by 11%. Non-performing loans. It is kind of like easy to expect that when you're where you're doing business in economies that are a little bit less stable or a little bit weaker than the Canadian economy or the US, you may run into a few hiccups. So this is what's happening here. Nothing bad though, but what is supposed to be a growth vector is pretty much anchor right now, slowing down ScotiaBank growth for this quarter. Where the growth came from, the first one was global wealth management. If you have followed my YouTube channel, I'm doing this quarterly review on banks like every quarter, and I've been telling you over and over that growth going forward, one of the most important growth vector will come from wealth management. This is exactly what's happening with ScotiaBank. Asset under management is up 5%, asset under administration up double digit. The revenue were up by 20%. It's kind of interesting because you have like a part where you have retail investors going with iTrades and opening up brokerage service account, want to trade by themselves. We've seen a lot of retail investor stories recently, and that kind of like drove earnings up as well. And at the same time, you have the other side of the consumers where you have the high net worth clients looking for more advice. So obviously they're going to be willing to pay like a 1% fee on their assets just to make sure that they have the right advice from their private banker. I've been there, I've been doing that job, and at one point, if you can pay someone to look over your assets and make sure that everything goes well, this is well invested money. It's not an expense, and this is exactly what we see here at Scotiabank. So great quarter for global and wealth management. Now, the last business segment, global banking and market. And at first I thought, hey, let's dive into the numbers. And then I realized maybe some of you are not too sure what is global banking and market. Basically, it's half of their business is coming from capital markets. So all the transaction, market making and stuff like that. And then the other half is their commercial arm where you have business banking. So mostly commercial loans and stuff like that. They are doing business in over 21 countries. But they're making a lot more money from stock trading, fixed income trading, merger and acquisition, and equity than from interest on this part. Overall, it was a great success. Adjusted net income up 20%. So basically, global wealth and global banking kind of like drove the growth for Scotiabank at this point. Unfortunately, international segment has been lagging lately. Now, moving on to the provision for credit losses, what I want to show you in this graph is that you have pretty much the same situation that we had in Q1 2020 before the pandemic, which is amazing news. So basically, banks are telling us with this result that, at least at Scotiabank, but you'll see it's a similar story at BMO. They're telling us Canadian economy is doing well. We're not too worried about what's coming up next. Actually, the loan portfolio performed better than expected. So provision for credit losses is a little bit lower than what we thought it would be, especially for a pandemic where we're still having lockdowns across Canada. We're still having people struggling. But what we see here is, unfortunately, the people that has been the most hit financially by the pandemic are people that didn't do well before, so people on minimum wages that are already in a bad situation financially. So it didn't affect much banks, but it affects thousands and millions of people. So that's kind of a sad story that is not being reflected in their balance sheet. To finish on this on Scotiabank, total loan portfolio at 626 billion, and you can see only 4% of it is highly exposed to the impact of COVID-19. In other words, they've been telling us that story for the past 3 quarters. Now it's the 4th quarter. They're telling us, you know what, you don't have to worry if you invest in Scotiabank. Our loan portfolio is very solid. We're doing well. and we are well capitalized. One thing that we haven't seen in that presentation is the CET ratio. That is the liquidity ratio that we follow at banks to make sure that they're healthy. So they're at 12.2%, so very healthy. Pretty much anything over 10 is very good. So at 12.2, it's amazing. So Scotiabank, good quarter overall, not incredible, but a good one, all things considered. I think that the international market has more ways to bounce back later on. I'm still not in love with that narrative. If I compare to other banks, it's not my favorite one, but just to say that they're doing okay. The dividend is safe. As soon as they are allowed to increase their dividend, they might wait a few quarters, but more dividend growth is coming for this one. And finally, they end up their presentation with a positive note. They know that there's a lot of digital banking companies that are coming after the big six, and they are now focusing on making sure that people are using their mobile or their tablet to do their banking. And the adoption rate in Canada is 56%, while across the rest of their business is at 47%. So there's still a lot of potential here. There's still a lot of work to do, but they are going towards the right direction. And I think that if they are not able, as banks, not just Scotiabank, but the big six, if they're not able to compete in the digital world, they're going to miss the boat, as many retailers did with brick and mortar businesses. Those who have been gone online are doing well right now. The others, not so much. So hopefully they will keep that focus on this one. Now moving on to BMO, who crushed earnings expectation this time. They're probably the favorite this morning at the time of recording. Right now it's like 9:45, so the market's about to open. Pre-market BMO shares were on fire. I don't know what's going to happen throughout the day, but let's just say that they did amazing. If we look at the dividend triangle, we have a similar situation where revenue was growing until 2020, and then obviously there was a pause in 2020. Earnings pretty much the same thing as Scotiabank, so went up and down because BMO business model is a little bit more volatile. They depend a little bit more on the wealth management and capital markets, so sometimes they have bad quarter, which kind of hurt their business. But recently, the story is all about provision for credit losses and COVID-19, so we see it on earnings. BMO has not been very generous with its dividend compared to other banks. In fact, out of the big six, they are the less generous among them. We can see the dividend has been paused for them as well. It's pretty much the same story for all banks. So far so good. Stock price has gone sideways since 2017, so we kind of hope that we're going to get a little bit more than the dividend at one point, but obviously just to see the stock price recover so nicely from the March drop in 2020 is already a bonus for many investors. So let's get to those earnings, shall we? Huge jump in adjusted income, up 26%. There's strong momentum coming from all across a business segment, and also lower provision for credit losses. So then again, they did well on the market, and they are doing well also with their loan portfolio. So for those two reasons, BMO is doing even better than Scotiabank, and they don't have that international branches to slow them down. So this is another reason why they have been doing so well this time. You can see the CET1 ratio at 12.4. So Scotiabank was at 12.2. Now we're at 12.4 for BMO. Another well-capitalized bank. Obviously, the dividend will be safe, even though it will not increase this quarter. But then again, very strong earnings report for this bank. Now, let's dig a little bit deeper into the Canadian personal and commercial activities. We have a very similar situation compared to Scotiabank, where loans were up, deposit were up. Unfortunately, interest kind of like slowed down a bit, and we all know why. So the interest margin spread is getting thinner. They're making less money on their loans, but the good news is the loans are still going up. This means that the banks are not worried about giving up money to clients. They are confident they are being able to pay back, and what you see here on that graph is the total provision for credit losses is pretty much at the same level it was a year ago. So we're talking about 147 million right now versus 152. So this is very good news, telling you that we're slowly getting back on track with what happened before. It's kind of like the pandemic is not really happening, the impact is not that big, and everybody that feared a great recession is likely not going to happen. So overall, pretty good news for all investors. Another reason of their success is actually their US segment that have done just amazing recently. Their activities goes from banking, wealth management, and obviously capital market. 43% of their earnings is coming from the US, and it has been quite a success recently. And this is one of the reasons why they had such a great quarter. When you look a little bit deeper into their numbers, you can see that revenue were up 7%. A lot is coming from deposit, up 24%, which is kind of amazing. And they kind of like managed to decrease their expenses. So this, like when you increase your revenue, you decrease your expenses. There you go, you get better earnings. And the PCL, the provision for credit losses, is pretty much stable in the US as well. So that's another good news. It helps the company to manage their loan portfolio and to bring some stability in their results. And we can see that this quarter was good, but you can also expect a few more good quarters from the US branches going forward. It's interesting how both banks, Scotia and BMO, are really different in terms of how they have built their business, meaning that ScotiaBank has decided to focus a little bit more on the international market, and then BMO is a little bit more in the US and towards capital market and wealth management. But in the end, they tell us the same story. So what's the story for wealth management? Well, revenue's up 35%, which is kind of incredible, and mostly driven by online brokerage. Then again, the retail investors are kind of like taking over the place, which is kind of interesting, and it's kind of nice to see that people are getting interested in investment, actually. Too many people forget that they need to save money aside and invest for their retirement. So seeing this, even though it means that a lot of people will make mistakes and maybe burn themselves a little bit, I find that it's a great news for the entire Canadian population. So I was very happy to see how retail investors are actually taking over control over the finance. So kudos to you if you're part of that group. BMO Capital Market, it's kind of like a weird beast for them because sometimes they make a lot of money, sometimes they don't make money at all. You can see it on that graph on the net income trend. You can see that Q2 2020 was a disaster. They actually lost money on this one. But overall, the trend is positive, and this is what's happening when you're dealing with capital markets. Sometimes you're making a lot of money, but some other times you're making a bad trade. Things go south, especially during the pandemic, during the market crash. They made some bad trades, and this is why they took a loss. But this time, net income is up 35%. Very strong performance from that quarter, and it will usually be a hit or a miss. Most of the time, BMO has brought on some strong expertise in their business segment, so they're doing well, but expect a little bit more volatility from this stock due to the capital market performances. Now, let's look at their provision for credit losses. For Canadian credit losses, we have a very stable situation here. So 149 this quarter, 138 a year ago. And then again, what I've put in red over there is that you can see that there was a uptrend, like banks are getting a little bit more cautious. They're taking a little bit more provision for credit losses. And then they realize, oh, wait a minute, like most of our customers are doing well. They are finding ways to pay their bills. And now the provision is going down, so which will help lift earnings up in the upcoming quarters at the same time. So all good news over there. And finally, then again, similar story for BMO. When you look at the total loan portfolio, we have an exposure to COVID-19 at 4.8% of the total loan portfolio. So they're not that much in danger, which is also a good news. So overall, BMO had a great quarter, mostly driven by their activity in the US and strong wealth management and capital markets performances. In Canada, it has gone like okay, like growth 1-2%. Same thing for Scotiabank. So we can say that in general, it sets the table that don't expect a catastrophe in the Canadian economy, but don't expect a huge growth. Actually, people are borrowing a little bit more because they're using those low interest rate, which is also a good news for now because it will help to kick back the economy and help it start again. On the opposite side, one day interest rate will go higher, and at that point it may lead to a more severe recession because a lot of customers don't think that one day they will have to renew their mortgage, their 5 years mortgage, and they will pay more than 2% on their interest rate. Just to end up on a positive note for BMO, digital adoption in Canada was close to 60%, so we're at 59.5, so that's very good. And for the US business segment, we're at 50%. Then again, there's a lot of work in the digital world to be done for the big six. They're kind of be a little bit slow to move towards that new trend. I hope that they will do it faster moving forward. I think that more than ever now customer wants to do their banking online, so we can see it's a good trend. They're already aware of it, and now it's all a matter of having those customers jump on their phone and do their banking. All right, so I'll be doing the same kind of video tomorrow. It's Royal Bank and National Bank, my two favorite banks, so I hope that you will be there to follow their earnings, and then we're going to end up this crazy week on Thursday with CIBC and TD Bank, so the most classic savings and loans bank to close the week. Until tomorrow, make sure that you do your homeworks, make sure that you look at your banks, don't expect any dividend growth, and until tomorrow morning, stay invested.